Our next guest, though, says that the stock market will be treading water later this year. Here to tell us why and where he thinks you should put your money right now is Doug Cliggott. He's U.S. equity strategist at Credit Suisse. Welcome to the show. Doug, I'm looking at your latest note. You say the market is looking a little rich and a little tired.
That's right, Margaret. I think the way we're seeing the U.S. equity market and really the U.S. economy right now is you've got two very powerful forces, but they're really working against one another. The real good news is profit margins are expanding very strongly. And with the productivity and unit labor cost data we got earlier today, that really focuses on how amazing profitability was at the end of 2009. Now that's the real positive news. On the other side of the equation, a lot of the excess liquidity that the Federal Reserve poured into the system at the end of '08 and early '09, that's starting to ebb away now. The broad monetary aggregates haven't grown in several months, and so we see, earnings pushing up the broader market, but the PE multiple coming down on those earnings because of the liquidity fading away.
Now, Doug, when you're talking about productivity, I'm glad you brought that up because you're looking at it really surging. And you would think, though, given today's retail sales numbers, it's looking like there's some spending happening in the discretionary space. Why are you such a skeptic there?
Well, I think we're coming off of an incredibly low base, Margaret, and I think, we're trying to set a strategy for where you want your portfolio to be positioned for 6 months out, 12 months out, 18 months out. And when we think of consumer discretionary, we're going to get employment growth this year, I hope, but it's going to be slow. Incomes aren't going to grow rapidly. Debt levels are still extremely high. So I think the average American household is just in a completely different mindset than 2 or 3 years ago in terms of discretionary spending. It's just going to be a lot slower than what we got used to in the middle of the decade.
Now, and looking at your latest note, it jumped out at me because you say your biggest worry in 2010 is that there could be an accident in the bond market. What do you mean by that?
Right. Well, and this is very contentious, Margaret, but when we look at what the Federal Reserve has been doing with its purchases of fixed income assets, over the past 14 months, the Federal Reserve has purchased roughly $1.4 trillion of Treasury securities and mortgage-backed securities. That's, again, we don't have the exact data, but that's roughly 65 to 70% of all new issuance has been purchased by the Federal Reserve. They're scheduled to stop buying mortgages at the end of this month.
Of course.
And so, we're entering a period where I think the risk, at least in our view, is that bond yields start moving up.
But why would higher bond yields have
low.
such a correlation with equities? I mean, why would you think that would be bad?
Well, if you look at the way a lot of people value an equity security, if you go on your Bloomberg machine and use the DDM function to get a discounted cash flow, the lower the discount rate is, the higher the fair value share price is.